Hey there, and welcome. If you're trying to figure out the complexities of a job exit here in the UK, you are in exactly the right place. This guide comes to you straight from the tax experts at ProTax Accountant, and it's all designed to give you the clarity you need for 2026.
All right, let's dive straight in. Losing your job is never easy. And then you might get offered what they call a goodwill payment. It sounds great, right? But could that good news actually hide a nasty tax trap? Well, that's the big question we're going to get to the bottom of today. So, here's what we're going to cover. First up, we'll break down what ex gratia even means. Then we'll talk about that magic number, the £30,000 rule. After that, and this is crucial, we'll look at the common tax traps people fall into. We'll even give you some tips on how to negotiate a bigger payment, followed by a handy cheat sheet for 2026. And finally, we'll talk about where to go for expert help. All right, so first things first, let's solve the mystery of this phrase. Think of ex gratia as the very first clue you need to understand your final pay package. You know, the name itself gives us a huge clue. Ex gratia is Latin, and it literally means out of grace. And that really gets to the heart of it. This is money that your employer isn't legally required to give you. It's a completely voluntary payment, a gesture of goodwill, often to make sure you part on good terms.
And this is where it gets really, really important. Just look at the difference. Your salary, your notice pay, any unused holiday, that's all contractual. It's a legal obligation on their part. It's something you've earned. But an ex gratia payment? That's totally different. It's for the loss of your job itself, not for the work you've already done. And that distinction, well, that's everything when it comes to tax. And here's a little pro tip that shows just how critical the wording is. There was a real court case where an employer made a payment they called ex gratia. But because they also described it as a gift, the court said it didn't count as notice pay, and they had to pay the notice period on top of it. It just goes to show the words in that settlement agreement are not just filler, they have massive financial implications. Okay, so now that we're clear on what it is, let's get to the part I'm sure you've been waiting for. Let's talk about the golden rule of termination payments.
And there it is, £30,000. This single figure is at the absolute center of how these payments are taxed. But what does it actually mean for the money that ends up in your pocket?
So here's the deal. The first 30 grand of qualifying payments can be paid to you completely free of income tax. Now, the key word there is qualifying, and it's a combined limit, so your statutory redundancy pay, plus any genuine ex gratia amount, all get bundled together under this one £30,000 umbrella. And here's a wild fact for you. That number hasn't been increased since 1988. If it had just kept up with inflation, it would be over £70,000 today.
Now, that £30,000 rule sounds pretty straightforward, doesn't it? Well, that's not all. Here's where most people go wrong. This is the plot twist, the part where things can get very expensive if you're not careful.
Seriously, stick with me here, because getting this next part right could literally save you thousands of pounds. A huge number of people have this idea that the first 30 grand of money they get when they leave a job is tax-free. I'm telling you now, that is absolutely not true. This table lays it all out nice and clear. On the left, you've got everything that's always taxed as normal earnings. Things like your notice pay, holiday pay, and bonuses. But on the right, you've got the stuff that can qualify for that £30,000 tax break. That compensation for loss of office is a key one. It's money paid specifically because your employment is ending, and it's separate from your regular earnings. The whole game is about correctly separating these two pots of money. Let's zoom in on Pylon for a second. That stands for Payment in Lieu of Notice. This is a massive trap. Years ago, it used to be complicated, but since 2018, the rule is crystal clear. All payments for your notice period are treated as regular earnings. That means they're fully subject to income tax and national insurance. No exceptions. And here's another pro tip for you. Your employer can't just call your notice pay something else to be clever. HMRC makes them use a special formula called Post-Employment Notice Pay, or PEMP. This calculation figures out the minimum slice of your total payment that must be treated as notice pay and taxed accordingly. It's not up for debate, it's the rule. Okay, so we've looked at the rules and we've looked at the traps, but what can you actually do about it? Let's shift gears now from just understanding the rules to actively taking control of the situation and negotiating a better deal for yourself. I really want this to sink in. When you're in this situation, it can feel like your employer has all the power. But trust me, that is rarely the whole story. They often want to avoid a long, drawn-out process or the risk of a legal challenge. A quick, clean, quiet exit is worth a lot to them. So, let's talk about your negotiation toolkit. These are the cards you can play. Do you have any potential legal claims? If they're asking you to sign something saying you won't work for a competitor, well, that has real value and you should be compensated for it. Offering that quick, clean break saves them time and money. And don't be afraid to ask if others in your role have received better packages. And never, ever forget to highlight your loyalty and years of service.
Now, you might hear the phrase without prejudice being used. Don't let that legal jargon intimidate you. It's just a standard way of saying you're having an off-the-record chat to see if you can reach an agreement. And what's more, for the final settlement to be legally binding, you have to get independent legal advice. And 9 times out of 10, your employer will pay for that. All right, that was a lot of detail. So let's just boil it all down into a super simple cheat sheet with the key numbers you absolutely need to know for the 2025 to 2026 tax year. This is the bottom line. The first 30 grand is tax-free. Simple. Anything over that, you pay income tax on it at your normal rate. But look at that third line. This is a fantastic point that's often missed. You, the employee, pay 0 national insurance on the amount over $30,000. Your employer, however, does have to pay national insurance on it at 13.8%. That can be a useful thing to know during negotiations. Look, trying to figure all this out on your own, the rules, the negotiations, it can be a real headache. And that brings us to our final and maybe most important section, finding the right resolution with some expert help.
So I want you to look at whatever offer is on the table and ask yourself this one simple question. Is it fair? And is it structured in the most tax-efficient way it possibly can be?
This is where the pros come in. An expert can look at your settlement offer, spot any red flags, and advise you on the best way to structure it so you don't pay a penny more in tax than you absolutely have to. It's about making sure every pound that can legally be tax-free is.
Okay, and before we wrap up, just a really important bit of housekeeping. This has all been for general guidance. Your personal situation is unique, so please don't rely on this alone to make financial decisions. You should always consult with a qualified professional.
And if you need that expert advice, the team at ProTax Accountant is ready to help. You can reach them on WhatsApp or by phone at 0795 689912, or just drop them an email at info@protaxaccountant.co.uk. For even more detail, go check out the full article on their blog. And of course, please do subscribe to the channel for more useful guides just like this one. Thanks so much for watching.